Hi, welcome to my weekly fundamental video. So this week we will look at how fundamental news has affected the correlation between the S&P 500 and UK 100, as well as the correlation between the S&P 500 and JER 30. The video will be laid out as follows. I will first explain how the correlation works between the UK 100 and SPX 500, with it looking at how the correlation has worked over the past week. I will then show how the correlation has developed over the past week for the DAX and the S&P 500. If you like an explanation of how this correlation works, then please see my video from last week, because I'm just going to explain on the UK 100 for this week, and if you want to see the DAX, look at the last one basically. I will then connect the correlation to this week's fundamental news, with this video finishing up by looking at the up and coming week's fundamental. So let's begin. The graph on my screen represents a correlation between the S&P 500 and UK 100. So the blue line is the S&P 500 and the orange one is the UK 100. So how are these lines calculated? Because these aren't actually the prices for the assets. So the graph lines have been adjusted so that the difference between the true values of the markets is removed, i.e. the SPX is worth 2,075 roughly, and the UK 100 is worth 6,340. So it basically just normalizes these. It's a process of normalization, so we can plot them on a graph and also compare them, because if it's quite difficult to compare them when you just use their true value, you have to normalize them. So and you get a nice chart like this. And what you can basically see here is that they move fairly in tandem. You know what I mean? In this here, the UK 100 is a bit of an anchor. The S&P 500 can shoot away, but it usually always gets pulled back. It can go quite far away sometimes, but it gets yanked back, as you can see. So sometimes it goes under, get it pulled back over, and so on and so forth. That's what happens. Very nice. And for those who like maths, the long-term correlation is 0.906. That's Pearson's correlation coefficient, with the maximum being 1. So the maximum correlation is 1, which means they're always moving together. And this one's 0.906, so they move fairly often together, as you can see on the graph. And basically that's how I trade. That's BB's correlation. As you can see, what I do is when they move out of correlation, so like up here and down here, I'd sell this and buy this, and they come back together, and that would have been a very good trade. So would have this one come back here as well. You get the picture. But the question is, what drives them to move together or move apart? And for this, I'm gonna pop up a screen of the S&P 500 as well as the UK 100. So let me just get this up. So this is a daily chart of the S&P 500, and what you can see here, what is needed to take note here is just the movements of the asset. So we can see in late August we had a big sell-off. The reason we had this sell-off was due to fears around commodity prices, mainly driven by the Chinese fears of global demand. The weakening China would have reduced the demand for commodities and other goods and services. So we had a sell-off, and then it bounced back, and it came back down, bounced back down, and then big up. So just note this movement. And because this is a big international effect, this drives not just the S&P 500 but also other indices. So if we take a look at the UK 100, as you can see, we had a very similar move. Sold off here. This is when the kind of fears really started to get pent up. We started getting a sell-off, and we jumped back up and back down. Just note the move for the moment. If we go back on the S&P 500, you can see that move. That's very similar. Back on the UK 100 last time, see, it's very similar. So as I said before though, we're not playing them moving together. We don't play this. We move them being apart. So, and this has happened quite recently. They've moved apart quite recently. So if you take a look here, these are Bollinger Bands. So what this is a 75 simple mean. So it's just the average price for the last 75 days. And this is one Bollinger Band away, or one standard deviation mathematically. So this is one Bollinger Band up, one Bollinger Band down. As you can see, the current UK 100 is sitting on its 75 mean. If you go back on the S&P 500, we can see it's actually above one standard deviation. 75 means here, and we're up here. So you can see they're discorrelated, they've moved apart. And what's caused this? Well, in my opinion, for the UK 100, if we go back on that, it's been kept down because of political uncertainty and economic uncertainty caused by the political uncertainty. This is mainly in the form of the up-and-coming EU referendum, as well as this week the government being defeated in the House of Lords. I think that's kept this in a tight price action, but this will just be discussed later in the video. But what you need to note now is that's a national issue, and that's kept the UK 100 down, whereas the S&P 500 has rallied because it's not affected by the fears, the uncertainty around the political situation in England. So we'll go on now to look at how fundamentals from the past week has affected the correlation of the UK 100, XPX 500 and JER 30 SPX 500. It's a good way to view this week's fundamental news, as well as being a good platform. So let's begin. It's important to note that last week we came off the back of dovishness from central banks in Europe and Asia. This sent the markets on a strong bull run. So as you can see here, this was Thursday, the ECB decision, or not decision, rather provocation of action, and then this is Chinese cutting the central bank interest rate. If we go on the UK 100, once again this is international, so we saw a similar drive. It's an interesting fact showing why they correlate as well, but just note that. We can also demonstrate that on the JER 30, the DAX. As you can see, on the Thursday we had the rally, and on the Friday we had another rally. So you get the picture. So it was coming into this week. It was of right expectation that this run had its course, and so there was strong belief that Monday would make a day of retractment. This stance for the week was also strengthened by there being little data release that could have driven international flows on Monday. However, there was an important national release, and this was for the DAX, the Germany IFO confidence. This was the main data release for the day. The business climate for Germany for October came out at 108.2 compared to an expected 107.8. To break this down into its components so as to have a more in-depth look at the German business climate, we can see that the current conditions came in at lower than expected. It was 112.6 compared to an expected 113.5. The lower than expected figure could have been due to a number of influences. It was the case that the VW scandal broke in late September, so fears around the potential ramification of the VW scandal could be seen to have been priced into the figure of weaker current conditions. Another factor that could have affected the weaker conditions is that there was also concerns about how the current refugee crisis and Germany's acceptance of the refugees will affect the economy and politics. It is the case that Angela Merkel's popularity amongst her people fell to a low that hasn't been reached since 2011, which was a time when Europe was battling against the European financial crisis. These concerns and uncertainty about how the refugee crisis could affect the German economy, political situation, could have feeded into the weaker current conditions. However, It was the expectations of future German conditions that pulled the overall business climate higher. Expectations for business climate came out at 103.8 compared to an expected 102.4. In my personal view, it is that the better than expected expectations were simply due to bullishness on the European economy. The effects of fear on China have started to take a backseat, and there have been some loosening of monetary conditions within the Eurozones. And by loosening of monetary conditions, I mean that firms can raise capital easier, as well as households being able to get capital easier. And how this affected the DAX is it actually allowed it to finish higher for the day. I mean, it wasn't a great move, it wasn't big, but it actually finished higher. And if we compare that to other indices, such as the S&P 500, that finished slightly lower. Once again, not a great move, but lower nonetheless, as well as the UK 100. You can see on Monday, that's Monday here, it's finished lower. Nice fall. So yeah, and that brings us onto our second news story of Monday, and that was the British government's House of Lords defeat. As alluded to earlier in the video, the FTSE has been kept in a tight daily price action. The reasons for this have developed this week. And so just to make clear, this is the tight price action I'm talking about. This kind here. It can't really make any higher highs, not much lower lows. So we're going sideways. The Conservative government of England had their controversial tax credit bill shot down by the House of Lords on Monday. The bill would have cut tax credits, which are government subsidies for the poorest of working population. It was a key part of the government's plan to create a budget surplus for the nation. By it being defeated, it posed two consequences for the political economy of Britain. One, it has made the task of balancing the books for the UK a harder job. This could have the effect of keeping money supply high for the nation, with higher money supply having bearish effects on the pound. So watch that. Two, it demonstrates weakness in the government as they are not able to pass bills. It is also important to note on this point that the government only have a small majority in the House of Commons, although it is too early to call. This defeat of the government could cause uncertainty about the current government stability. Although this is not a decisive blow, it's more of a push towards weakness, if you see what I mean. And this story has been exacerbated by the news this week that the House of Lords is planning to take on the government again over terrorism legislation that allows the police to view the internet history of citizens of the UK. This did result in Theresa May dropping some of the more contentious parts of the bill this morning, Sunday, today. There has been claims that the blocking of the bill is anti-constitutional, and that's the blocking of the tax credit bill. However, this is not true. The House of Lords is allowed to amend or block any bill that was not contained within the government's manifesto before being elected to office. Tax credit cuts were not in the manifesto. The instability, along with the uncertainty of the up-and-coming EU referendum, has arguably caused tight price action on the daily chart over the past couple of weeks. So yeah, I'm thinking the EU referendum has also caused this sideways movement, because people don't know how it's going to affect the economy, or how it's going to affect, money flows and everything. People don't like to trade uncertainty, so to speak. It's risky. It's less likely to develop a direction. So you've got a bit of a revolving circle there. So just keep going sideways. So how has this affected the correlation? So I'm going to bring that up now. So yeah, this is the distance between the S&P 500 and DAX. This is the first chart I've showed you. If I just bring this back up, it's this chart compressed into one. Obviously this is the UK 100, but I have another graph with the JER 30, which can be seen in my video from last week if you want to check that out. But basically it's just this compressed into one line. And this was Friday, so we're using that as the start point to see how news this week has affected the distance. And the better than expected German IFO business climate and in all its ramifications led to the difference being decreased. We had a solid move up. It's minus 150. Well, it started on minus 150 from Friday because the DAX is below the S&P 500, and obviously the DAX has risen and come closer to the S&P 500. So if we now turn to the difference between the UK 100 and SPX 500, yeah, we got slightly closer. I mean, once again, we've got the 23rd, and we've actually got Saturday, and Sunday on this one. The only reason for that is I couldn't actually get rid of them, so I apologise for this. But yeah, that's Friday, and this is Monday here. And as you can see, between the 2 points, not much of a move. They got slightly closer. Arguably maybe the FTSE got a bit of benefit from the contagion of the German data, and yeah, but it wasn't much of a move. You know, the FTSE's not moving greatly, and the SPX didn't move greatly, so we got slightly closer. Now, yeah, so that brings us on to Tuesday, which was a fairly important day for the data release. So let me just get that up. So yeah, we're back on the chart of the JER 30 daily, and that's because we're talking about EU loan growth, which showed a positivity as it came out in line with expectations at 1.1%. This was also compounded by Italy saying government debt at a negative rate, meaning that investors have to pay to lend money to the Italian government. The yield was minus 0.023%. So investors have to pay on a yearly basis 0.023% to loan money to Italy. These two happenings show that both ECB action and provocation is feeding into markets. It is now a question of the effects on the real economy, which will the basis of judgment for more action for the ECB. So basically, markets are pricing money cheaper at the moment, like for Italy, negatively. So it's so cheap that they have to pay to give it to someone, which is quite an unusual happening. Well, it's not unusual recently, but historically it is. So yeah, it's just a matter of whether that cheap money will now start being used by companies, even by governments. Governments was a real focal point of the ECB. They wanted them to invest more in structural changes, raise infrastructure, and so on and so forth. So that's the question, will it feed in? And another important data release on Tuesday was the UK GDP. So if we get the UK 100 chart up, UK GDP preliminary reading was released on Tuesday that showed a lower than expected reading, with quarter-on-quarter growth at 0.5%, expectations for 0.6%. So how did this affect markets? To see that properly, we're going to flick down onto the hourly chart. And we're going to have to find where the data release was. It was Tuesday. So this is Tuesday here. The release was at 9:30. Here, as you can see, not much effect. Yeah, sorry about that. There wasn't actually that much effect at the time. As you can see, it made a star. This shows indecision. Investors didn't know whether to take it positively or negatively. Let's say we went down and back up, or down and back up. See what? But overall, it could have helped the day finish lower. Ooh, sorry, crazy. Yeah, that's really bad. Okay, I really apologise for this. We're having a bit of technical problems, but we're going to continue on anyway. Push on, push on. But yeah, it could have helped it fall for the day anyway. So we're going to get off that chart because it's causing us headaches. Yeah, we're moving on to the US now. So yes, go on the SPX 500, and hopefully that chart will treat us better. And the release was, there was a couple releases. First of all was the durable goods orders. This was fairly in line with expectations, so it didn't really cause too much. However, I think the big drive was the US Red Book. The Red Book is a measure of retail sales within the US. It came out at 1.5% compared to an expected 1.3%. Consumer expenditure makes up just under 70% of GDP. It is also a signal for inflation expectations, for the simple reason that more consumers buy, the more there is money chasing scarce resources, leading to inflation. So once again, this was a bit like Germany on Monday. It allowed the SPX to be the only index that finished up, but even though it wasn't greatly, it finished up. If you take a look at the UK 100, please be good to me. Let's go back on that daily. Yeah, as you can see, this finished down quite strongly. We had a quite strong sell-off. Yeah, and if we go on GER 30, yeah, we finished down. So Europe was down, and the S&P finished up, and that's all good. Yeah, pretty much. And how did this affect the correlation? Well, yes, look at those charts again. So yeah, the rally in the S&P 500 and the fall in the DAX caused them to go further out of correlation. I mean, we went back to the point Friday, because as we said on Monday, we had the slightly higher open on the close on the DAX and slightly lower close on the S&P 500, putting them together. We had the same again, so we pulled it back apart. Now if you look at the FTSE 100 or the UK 100 and the difference, Tuesday they move quite far apart. We had a big pull away. This was due to that big sell-off we saw and everything, as well as the XBX finishing up because of the data. So yeah, we moved apart. Yeah. So yeah, let's move on to Wednesday. So Wednesday we had some good price action on the S&P 500, and this was because the big news for Wednesday was the Federal Reserve's interest rate decision. It was the case, like so many gone before, that the Federal Reserve kept the benchmark interest rate at the 0.25% level. However, it was a statement that moved markets. Coming into the meeting, it can be seen that investors were not expecting much provocation from the Federal Reserve, nor were they expecting much action, but that's almost a done deal at the moment. This was due to them cancelling the press conference that was meant to be taking place after the meeting, as well as a raft of weaker than expected data being released on the American economy that was all started off by last month's non-farm payrolls. However, investors were taken aback when Fed remarks had decidedly hawkish tones. It was a reduction in the Fed fears around global growth. It's being that the Fed does not see this global slowdown as much of a threat anymore as it had previously done to growth prospects for the United States of America. Yeah, and so this had quite a big effect, as we saw a rally here, but on the expectations for interest rate rise, and I've got a chart for that. So yeah, this is just the January rate hike probability. This is data from CME Group, who use Fed futures contracts to work out what's the probability that the market is pricing into a rate hike. As you can see, we started off the week quite low, 42% roughly, and then after the Fed interest rate, it jumped up to 70%. As you can see, there was a big move. I've plotted this like straight, so assuming they move the same every day, just to demonstrate the big move. But it's moved a lot. It's not quite doubled up to 80, but 70% is quite a good point. Like the Fed quite like raising interest rates when the probability is at 70, because it doesn't have such great ramifications to the markets. But yeah, that's interesting. So January definitely on the cards. People are saying December's is on the card. Don't know, I said January for quite a long time and a bit dogmatic about that, so I think it still will be January, but December is on the cards, much more so. So yeah, let's move on. Yes, move back to the SPX 500. So yeah, this affected the S&P 500, and to look at the true effect, we're going to drop down to the hourly, which hopefully will treat us right. And where we're looking at Tuesday or Wednesday even, which is never a good start getting on the day. This is Wednesday. So this was the meeting here. 6 o'clock. What you can see happen first was it initially sold off, big sell off, bang, straight down here, and then came back. The reason for this was the hawkishness initially made investors feel that the cheap money is going to dry up, and this form of move, this straight down after release when it's hawkish, is quite common. But what's also become more and more common is it then to turn around and rally up. And the reason it rallies after a sell-off is due to investors trading with the Fed, being that the Fed is more bullish on the economy, so investors become more bullish on the economy, i.e. they trade with the Fed, so they think the economy is going to get better, so the S&P 500 gets stronger. So to plot that out, fear around cheap money drying up, good economy. Fear, bullish, rise, as you can see, and that's quite common at the moment. It happened last meeting as well, and everything. So yeah, and yeah, once again, this is an international. The Fed is a price maker for interest rates, which means central banks tend to follow the Fed move, like the ECB and the BOE. They're quite coordinated. There's quite a strong argument that other central banks won't raise interest rates until the Fed do. So yeah, this was once again replicated on other markets. So let's take a look at the UK 100. As you can see, strong day, bullish, straight up, ate that one completely, back up to this top of this tight price action, and then on the DAX as well, strong day, as you can see, bullish, boom, beat both last 2 days. Yeah, nice and strong. So how did this affect our correlation? So let's bring up those charts again. Yeah, so the hawkish stance from the Fed led to a greater rise in the S&P 500 than the DAX, due to the Fed having more of a sway over its domestic market. Or there is a price maker, as stated before, so it drives world indices. So as you can see, on the 28th, got further apart between the 27th and 28th. They moved apart, so a stronger rally in the SPX 500. And if we also look at the FTSE and SPX difference, we can see 28th here. Yeah, it got further apart because once again it was stronger on the SP 500 than the FTSE 100. Yeah, and now that brings us on to Thursday. So yeah, Thursday kicked off with German and Europe news, and there was a change in sentiment that occurred on Thursday in European markets. This was due to the inflation rate data release. It had been the case that early in the day we had the release of the German unemployment figure, which came in as expected at 6.4%, which did not greatly move markets. But it was the inflation figure for Germany that caused a stir. It was released better than expected at 0.3%. The significance of this figure was that it showed positive inflation compared to the previous release of neutral inflation at 0%. Holding every other variable still, this release should have been bullish. However, with the recent provocation from the ECB that it is going to use all possible measures in December to raise the inflation rate back to its target, the release led to a sell-off. This was due to investors seeing there being less reason for ECB to conduct further monetary policy loosening. So yeah, we can look at this on the hourly. Let's go back down on the hourly. And Thursday. That's Friday. And this is Thursday, as you can see. And the release was at 1 o'clock. See, yeah, release came out. We didn't really know, and then bang. Sell off, just bang. Yeah, that's because, as I say, because of the ECB possibly conducting more stimulus in December, now looking less likely because of the inflation rate coming back. But it did strengthen again. Got to remember, good inflation is good at the moment. People really want to see inflation, so that's positive news overall. So we came back up. Now we also had news from the US, and that was the GDP figure. So let's go back on the S&P 500, if it will let us, and we're going to daily. and we're dealing here. So USGDP came out at 1.5%. This is below its long run average of 2%, marking a weaker quarterly growth this month. The slower than average growth was due to the rate of corporate inventories falling. This is that companies are producing and then storing products at a lower rate for future sales. It is consumer demand that kept the GDP figure alive, however, which showed rising household spending of 3.2%. Consumer demand is not only a core part of the driving force behind GDP, but is also on the Fed's watch list of elements that would drive a rate hike. Further, although this is slightly too early to make a prediction on, one can argue that the fact that consumer demand is rising with lower supply of products through lower inventories, this effect combined could lead to price pressure building up, leading to a return of inflation. Although in the short term, the weaker than long term average GDP led to a rally in the SPX 500. This could be due to it making the possibility of cheap money being extended, although there was not much of a rally, so arguably did not change investors' sentiment a great deal. So yeah, the slightly weaker than expected, or longer compared to its long run average, led to a little rally. Yeah, I mean, say it's due to investors thinking cheap money will last longer is, I don't know, it's a bit of a strong call, but I mean, we did finish up, so for your ball, that's all that matters, isn't it? Let's go on, look at how this affected the correlation. But first, before we do that, we must take note of the UK 100 move. There wasn't much fundamental news here, but the UK 100 sold off. Now this is because it's got to the top of this tight action and it's sold off. This is technical drive. So yeah, now let's go on the charts of the difference. So yeah, this is the distance between the SPX 500 and the FTSE. Yeah, so as I said before, the FTSE hit the top of its wedge and sold off. This was a technical drive that led it to go into further disparity with the SPX 500. Because the SPX 500 rallied due to the GDP data, whereas technicals forced the FTSE 100 lower. So as you can see, we moved even further out correlation. That was quite far. Now I did enter a trade at this point, buying the FTSE 100 and selling the S&P 500. Yeah, so that was opened, and that's because of the disparity being quite large. There's about a 10% chance it can go further out. So yeah, let's look at the DAX correlation. We had a similar thing on the DAX. Yeah, the two data releases kept the DAX at a large difference. I mean, it didn't really drive it too further out, but yeah, it was still quite far difference as well. Yeah, so yeah, still out. And now let's turn to Friday. Yeah, we're starting on the DAX for Friday, and this is because we had EU unemployment. We had swinging sentiment on European equities. This came through in the form of the unemployment figure for Europe, which showed a fall in unemployment from 10.9 to 10.8. Expectations for the release was that unemployment would actually rise from 10.9 to 11, which was why the news was taken so positively. So it actually fell when they thought it would rise. So once again, let's go down onto the hourly to inspect this. And the release was at 10 o'clock. Here. Once again, we had a sell-off. Strange, but once again, similar to the inflation reason, was because less likely that the ECB is going to have to do more. It's because falling unemployment arguably leads to inflation. It's because more people have more money to spend in the economy. So this sold off, as you can see. Boom. But once again, because it is good news, this did turn around and we had another rally. Bang, back up. So we get quite a mix, we get swinging sentiment, you can say, swinging sentiment. Sells off, drives back up. Interesting stuff. Yeah, and that was the major news. So we're going to look at how that affected the correlation. So the swinging sentiment led to the SPX and the DAX coming strongly together. It hasn't been this close all week. and we had the furthest point, so it really pushed them back together, which is quite interesting. Yeah. Yeah. Arguably, this was also due to technical moves on the S&P 500, and I'll just bring that up for you. So yeah, here we have the technical move. We had a kind of like an evening star here, as you can see, and then a big sell-off. See, it's kind of a bit of a technical one. So, and yeah, and remember we had the rally in the DAX. So if we just go back on the GF30, put it on the daily. Well, it's not a rally. It didn't finish any. Well, it finished a little bit lower. It wasn't a big move, but relative to the SPX 500, this is quite a big move. Not a very big move. So yeah, let's go back on. So yeah, this is what caused this to come back together. So we move back together. Now if we look at the way the FTSE and the S&P 500 moved, not very much, because the FTSE continued to sell off in its little tight price action down to the bottom, with the S&P 500 also selling off. So if I just show you the sell off on the FTSE, yeah, so we came back down here. See what I mean? It's coming back to this bottom of this tight action. Fairly predictable, a bit dull, but a big move. Good day if you're short in UK stocks and everything. That's all good. Anyway, so yes, now go and look at next week, forward-looking statements and everything. So yeah, China should come back into focus on Monday. The MBS manufacturing and non-manufacturing PIs have been released today and show figures that were weaker than expectations. Manufacturing was 49.8, expected was 50, and non-manufacturing at 53.1, expected was 53.1, so that came in line. And it's important to note that anything above 50 for PMIs marks expansion, and anything below 50 marks retractment. This is why manufacturing PMIs is a bit of a shock, as it notes a retractment when investors were expecting it to be neutral. So this is the manufacturing PMI was 49.8, expected was 50. So yeah, that could drive markets going into Monday's Asian session. This could also be added weight by the Caxton manufacturing PMI. That's out Monday morning at 1:45. This is UTC time, so that's during the night for everyone who lives under that time code. We also have the US ISM manufacturing PMI. Sorry, I forgot to put US there. This is for the United States, this one. United States. That's out Monday, 3 o'clock. This is important as it relates to growth in this sector, with this having ramifications for employment and investment, both drives of inflation, so it's connected to the Fed decision. So yeah, that's quite important. Definitely watch that. Tuesday, we've got the RBA, the Reserve Bank of Australia, interest rate decision. At the last meeting, the central bank stated that it does not see much need to loosen monetary policy, with, in my opinion, there not being much cause to change this mode of thinking. I don't know. Comment on that if you have any different opinions. That'll be a good one. Yeah, and then Wednesday, yes, things start to heat up stateside. AD employment change, a guide to the biggest release this week, the NFP. So you can start maybe making some deductions onto how the NFPs are going to come. We also have balanced trades, and this will see how the US dollar has affected trade, the strength of the US dollar, which has only got stronger this week as well. So yeah, that's a big one. Watch that. ISM non-manufacturing PMI is also out on Wednesday. This is for the States. Once again, I forgot to put the US. I apologise for that, but that's out on Wednesday at 3 o'clock. And that's important, similar to this, because if it shows expansion, it means more people are getting employed in the non-manufacturing sector. Could also link to wages and also just investment. So any of them things. And this is all good for inflation. Well, expansion is negatively. Yeah, we also got Janet Yellen speaks. Now these are all quite commonly important, but probably arguably more important this week because there was no press conference. So people might be looking for some hints, more guides from the decision making by the Fed. So yeah, that should be interesting, man. And then Thursday is a big day for the UK. We have the BOE interest rate decision, the Bank of England. As usual, I'll be doing a summary of this. So if you wanna watch that, please do. It'll be good. I release it pretty quickly as well, so definitely something to watch. And you can ask questions as well. That's a big one. Make sure you do ask questions. Quite like it. So yeah. We also got Fed, Harker, and Dudley speaking in the evening. Also afternoon. This is important to a similar reason that Janet Yellen's speaking, because we didn't have a press conference, so we can learn about what the different parts of the Federal Monetary Policy Committee were thinking and how they came to their decision. Yeah, and then Friday, as stated here, NFPs. These are always big. They always cause a lot of volatility. Arguably this one's big, but yeah, they're always big. I don't really know what to say. Yeah, watch them. They can do some real driving forces. Yeah, and be careful if you're in longer term positions or medium term positions. These can really come and catch you out. So watch that. Alright, wicked, and that kind of sums it up for this week. Yeah, sorry about that. That sums it up for this week. We've had a few technical glitches. We're pushing through. We've pushed through, however. Thank you if you stuck with us. I do apologise for all that and everything. And I hope you enjoyed it. Have a good week and good trading, everyone. So yeah, thank you.